I'm looking to invest today to hand the keys down to family members because these are all brand new properties. We build them in a manner that is going to last and hopefully gain the most appreciation, rental rate rise, and a value wise going forward with the style that we do.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 445. My guest today got his start in real estate as a high school student, attending foreclosure auctions at the courthouse steps in Memphis, Tennessee. Since then, he's completed over 1,000 real estate transactions worth over $250 million, including wholesales, flips, new builds, custom homes, vacant land, and just about anything else you can imagine. Brock Holliman is here today to discuss his career as well as his current build-to-rent strategy. Brock, welcome to the show.
Brian, thanks for having me, man. I'm excited to be here.
I'd really love to hear how you got started in real estate and love the story of you on the courthouse steps. I can't wait to hear that one.
Not the conventional path, because it kind of started when I was in high school. So, but back then, this was like 2010, 2011, where as you know, it was just like bottom of the valley depression in real estate. Everybody was like, oh, wow. They were, talking trash to people who were buying real estate, which they turned out to be the geniuses, right? So anyways, back then, I was working at IHOP at the time, and I also had a little lawn mowing business in Memphis where, the grass only grows half the year. But my clients were not like you, they weren't like the neighbors or anything like that. My clients were actually the banks that had vacant property because, 50% of the country had housing that was vacant. So what happened was, they would give me, I had a little contract with a local bank there. They had probably 40 to 50 houses that needed mowing. So I would take care of those. And as that's happening, my father was a home builder, or still is, but, sort of still is. And anyways, that you can't really have real estate without, or construction without real estate. So there was no work really going on with the home building industry at the time. And he kept telling me, son, you got to figure out these foreclosures. So yeah, being at the bank or doing the bank houses and all that stuff, led into checking out these real estate auctions, the foreclosure auctions, which at the time there was just an abundance of inventory that everybody was trying to get rid of. And like the rules on these auctions were so relaxed because they were just, let me get rid of this book of properties, no matter how they did it, no matter what the price was. So I went there to check it out. I remember the first auction I went to, it was during a school day because I'm in high school at the time. And so I skipped school and went to this auction and didn't know my father had a speeding ticket court date. So he was walking up the steps as the auction started. And I lock eyes with him like, oh, shit, there's my dad. So at first I was a little nervous. My heart dropped into my stomach. And then, he realized what I was doing and he was so proud. And it was just like a confirmation of this is the right lane to go down.
He had no idea you were skipping school to go buy houses at auctions.
No clue. And, I had a little, not to get off track here, but, the school ladies would usually, that's when they just started to call like your parents. So Brock wasn't at school today. But me, my best friend and I, we were like great salesmen in high school, okay? And we would just go kiss butt of the attendance ladies. We'd bring them donuts. We'd bring them, little Starbucks coffee, whatever we could. And they weren't making these calls like for the other kids.
How much school were you missing?
Oh, dude, I've got my transcript. I found it the other day when I was cleaning something out, and it was like 51% of the days I was there. And I remember being called in there multiple times in the junior and senior year, and the principal's like, look, we need to sign you up for summer school. I'm like, I'm not going to summer school. You're required to go to summer school if you miss more than 50% of the days. So of course, I'm only going to miss 49% and had to, we got to forego the old summer school. But yet, it's nothing I would want to teach, my kids someday. But at the same time, I'm proud to tell that story.
The 49% of the time that you weren't in school, were you at the courthouse steps doing real estate, or were you doing other things?
I wish I could just say yeah and sound like some little workaholic genius kid, but no, I was partying, man. We it was like half party, half making money. So yeah, I never had any friends that were younger than me, really. I mean, a couple of them, but they were select outliers, and all my friends were sort of older than me. And I was a freshman, and like all of my friends groups were juniors and seniors. So as time went on, they're all in college and they're going to the University of Memphis, which was 20 minutes away. So it's like, and they're partying every night. So it was sneak out of the house, go down to Midtown and party with these guys, and then hit a couple auctions a week. And but moved on from all that. You learn off of those kind of things. I wish I would have focused more time and energy on the real estate side then, and I'd probably be a lot further than I am now. But at the same time, I look back and I had a good time. It was fun, and I don't think I'd change too much of it. So
you're in high school on the courthouse steps. Did you actually buy something?
Yeah. So my first purchase was for $7,200, and nowadays if you go to an auction, a foreclosure auction, you've got to go and they're going to say, okay, let me see your money. So you got to pull your cashier's checks out and show them that you've got money, so they'll take you serious as a bidder. But back then, with all the inventory, it was like they weren't checking cash. They weren't making you pay at the same time of the auction. You had 24 hours to pay. And if you could sweet talk them like I could the attendance ladies at school, then you could buy another 24, 48 hours out of it, telling them you had a busy day, you can't make it there today, blah, blah, blah. And they work with you. And they were working with me. But yeah, the first house that I actually bought and didn't wholesale was for $7,200. But I'd say the first 20 transactions were I'm winning the bid. I don't even know who my cash buyer is. It was just like, figure it out.
Were you flipping, like just wholesaling these right from the courthouse steps, or did you close on any of them with your own money?
The first 20 were probably wholesaling without any of my money. So it was win the bid. Then I go home, and the internet, this was all available on the internet, even though this was 15 years ago or something. And you could go on there and just see cash transactions on the recording office for the county. And I would look in these zip codes and see who's been buying and filtered by the last 30, 60 days, and then just go out and find them. Whether that was finding the number on Google and just giving them a call, or seeing where their office was locally, just showing up and introducing myself, which maybe was a little bit difficult being so young. But at the same time, I remember I had one guy named Charles who he trusted me, and he was buying something every week. So it was like a typical deal would be like, I win it for $11,000, and I see the auction coming up, say the auction's tomorrow, and I'm going to call Charles and be like, hey, I got one in your area coming up. I know it's a good deal, blah, blah, blah. And it tells me the starting price is say $10,000 on it. And I'm gonna get it for 18, and I tell him, look, I can get it for you for 25, but we got to close in the next 2 to 3 days. This isn't. But if he were to buy that on the MLS, he's probably paying 40, So it was a quick deal. And instead of wiring me the money, he would wire it to the trustee's account. And then the trustee, like if it's a $10,000 purchase, you could literally give them a $100,000 cashier's check or a $100,000 wire or whatever. And then within 2 weeks, they're cutting a check back to you. They're calling me to come pick it up. Here, we got a refund check for you. And those refund checks were my wholesale fee.
You're in high school. How much money did you make during that period?
I made a lot of money probably, and didn't realize how much I was really making because, coming out of it, being a kid, like you don't know, you really don't know the value of money and how hard it is to really come by. And it was just coming really easy at the time. And not for many people because the world was in sort of a depression, but I was spending it like it was water, Brian. And in fact, if there was that was a huge lesson. I learned a few massive lessons off of that period of life. And one of them was, instead of blowing the money on Gucci work boots that I'm going to wear out to a flip job, like who does this stupid? Or, whatever, just going to trips here or going partying and inviting all those friends and renting out a booth or whatever at the club. Just stupid. And, so it's hard for me to even know like how much I made. I just remember yeah, I'm spending it like it was water. And then I don't know, it was like in the summer of the year that I graduated, 2011. And I remember being at like some bar and I had to get some money out of an ATM. And one of my friends was there. And I remember getting the little slip that says your account balance. And it said $99,634 or something really close to that. And he was like, man, Brock's got 100,000. And I just went along with it. You know, you're a kid, you're stupid. Now I don't really tell anybody, you know, but we're on a podcast, of course, but you know, the crazy part was I actually, that same account went to negative 5,000 before it ever hit 100. And so that is kind of where I learned the value of the money. And then at the same time, when you see your money up that high, when you're off of zero, you're like, you feel like, oh, I've made it. And you automatically start to pull back your intensity and effort level, that's probably the biggest thing that I ever learned. So now, like if I hit a good lick on some money or get good profit or something, just whatever intensity level, whatever energy it took to take that out, just not letting up and trying to double down on that energy, you know, and keep stacking wins instead of, you know, taking the win and taking a break.
Did you find that, you know, you make $100,000 while you're still in high school? Did you find that you had that sort of that downslope as well that usually accompanies people who make so much money but aren't really equipped or to handle that kind of money? Did you have that downslope?
Yes, 3 or 4 times. 3 times for sure. 4th time was like so close to dipping in a negative, but got my stuff together before it was there. But yeah, crashed and burned.
At what point do you feel like your mindset shifted on handling money and having that kind of money so that you were able to kind of go to the next level?
25, 26 years old. Today I'm 31. And really, and I hate to sound like the old, you know, the original real estate interview where they're, you know, what did it? But swear it was the old book from Robert Kiyosaki. That one, I listened to that because I'm not a great reader. My focus level can't just sit there and read the pages as fast as I can pick it up if I've got an audio book. And I just remember at the time I was splitting a lot of time between Florida, Memphis, and New York City. And I would constantly, my dog is my best friend, is my little son. Okay. So he goes with me everywhere and he can fly everywhere. But at the same time, he gets aggressive if there's another dog on there. And we got kicked off of a flight in New York before it took off the runway because there was another dog in there. And since then, he hasn't flown with me. So I did a lot of driving. And during those drives, it was like, I love to drive and listen to books or podcasts or learn about taxes or whatever. And that book really just did it for me. Like it opened my eyes so much. And I'm like, before that, like I sold my rentals and I'm like, I'm never going to get rich making $200 a month, you know, until you start seeing the power of this stuff. And like, oh my God, this stuff that I sold is now doubled in value. The rents are doubled. I didn't know anything about taxes. I could have written stuff off against this or that. And, you know, and everything just sort of hit. So I remember listening to that book. And then as soon as it was over, I listened to it again. And it just, you know, it stuck with me.
And the book you're talking about, you said Robert Kiyosaki, it's Rich Dad, Poor Dad. You know, so many investors have come on the show, and that is the pivotal book that really changed things for them.
It is. And then Cash Flow Quadrant was actually, I liked it better. But you shouldn't listen to that one or read that one without the first one. But the Cash Flow Quadrant, it's like, okay, you figured out what you need to do. Now, this is the path that we want to be on. Like what is it, EBI? I forgot. I should know. Okay.
Employee, business, investor, and then there's a fourth one.
Like big business, or I forgot what the fourth one is. Gosh.
But anyway, yeah, people listening can fill in for themselves. But so, all right, I want to follow this story because, I mean, this is really interesting that you're creating so much success at such a young age. And then carrying that momentum forward, you know, throughout. So what was the next level at which you realized, okay, you read that book and right around the age of 25, how did it change your thinking and how did you change your real estate investing strategy at that point?
All of a sudden, I went from flipper to investor. Well, I guess even when you're flipping, you're investing, but flipper to keeper, holder. And you realize that people make a lot of money or they get rich or whatever on real estate by I mean, you can do it by being a broker, and if you're a killer broker, like these guys on TV or whatever, or you can do it by wholesaling or flipping, or you can see the most wealth is created in the people that don't sell, or with the people that don't sell. So now every time, like if I'm underwriting an area that we're going to be doing build to rent in, it's an area that I'm confident in investing in. And I'm not looking to invest today to sell in 2026. I'm looking to invest today to hand the keys down to family members, because these are all brand new properties. We build them in a manner that is going to last and hopefully gain the most appreciation, rental rate rise, and a value wise going forward with the style that we do. But yeah, I think that's where it kind of just shifted everything. So just go, how do we keep stuff? And now, like right now, if we have 10 contracts that fall out, is it going to dent my pocket to keep them? Yeah, I mean, I've got to come up with some money, but along this way, like there's been so many other things that have been harder tasks. And this is a rewarding task if we figure this out. And I'm happy to keep. Of course, rates where they're at make it a little bit more difficult, but when we've got a build cost that is, quite significantly lower than appraised values are coming in, that helps out too.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat-fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. You mentioned build to rent, but you've kind of changed your strategy, not just to fix and flip, buy and hold, but now you're building to rent. So talk about that. Like, what does that really mean to you when you say build to rent?
So build to rent to me, we're basically, you would normally see, D.R. Horton or any of these big builders, any small builders, they're building to sell. So they'll put their model house there. They'll get a sales team. They got all their sales brochures. They throw their open houses, and then they sell to retail public that's going to move in and live there for 20 years, 30 years, or however long, 10 years, whatever. Our end, on our build to rent, we are basically doing the same exact thing. We've got our models, we've got our salespeople in there, but we're selling very little retail. We focus on rentals. So instead of it being like a sales center, it's a leasing center. And it's, we do this sort of like a multifamily style, but it's all single family, mostly single family. We've got some small multis like duplexes or like 6-7 unit townhome buildings, stuff like that. No large multifamily projects. So just think of it as, a community or an area that has a model home, and it's basically a leasing office.
So kind of like a mixed community where you have some small multifamily and then detached single family townhomes or like that?
Yeah, so down in Florida, it's very unique. I haven't seen this really anywhere but Florida, but we've got a lot of PUDs. So it's like infill lots, but these areas were developed back in the 50s, 60s, 70s, and they were developed in these single lots. We're talking thousands of lots that were sold off to, people. Most of the people were in New York, if you look at the tax records. But it's basically infill lots and huge booming areas. Like right now I'm in Northport, where we've got probably somewhere around 40 to 50 houses going right now under construction. And it's like from one house to the farthest house, it'll probably take you 15, 18 minutes to get there. So it's not like they're all on the same street in these little PUDs I'm talking about. So, but at the same time, we've got two of these PUD areas that we're in that have models.
You say PUD, which stands for
planned unit development or planned urban development. And, I should know that, okay, which the difference is, but I don't know. Either one, they both kind of sound the same to me.
Please keep going. So you've got all these PUDs, and then how are you leveraging that and handling that?
So everything's so spread out, but there's a lot of PUDs in Florida, but there's a few that I really truly believe in. Northport's a huge one because it's right here in Sarasota County where, the state average is 66% owner occupant housing. And here in Sarasota County, it's 76%. Our median incomes in Sarasota County are 20% higher than the rest of the state. And it's one of the richest counties in Florida. So that's why I'm really focused on this one big time. But basically, we're in the most affordable area of the county, and it looks beautiful. I live in these areas too. So it's not like I'm living on the water, looking at the ocean. I probably could, but at the same time, I'm more effective, especially at this age, to bounce back and forth and make sure we have our operations rolling like a well-oiled machine. So I bounce back and forth in these areas. I love Northport. Like right now, my office is 2 minutes away. I came here to do the show with you because it's more quiet. And I love living in these little areas. So they're good, great areas. And I feel comfortable investing in them. And when you look at the demographic push, there's so many wave of people moving here, and they're picking these little zones that we're in. So that's really great. But at the same time, we also have some small communities where it's just you'll go in there and it's nothing but our product, which I would prefer that. But from a building side, maybe an investment side, it's sort of a coin flip because some people don't want a whole community of rentals. I wouldn't mind it. It's like saying I wouldn't want to buy an apartment complex. But yeah, I feel like I'm bouncing all over the place, Brian.
How many are you building in these communities? And what's kind of your sweet spot there? Like when you do these build to rents, how many are you looking to do? What's the cost to build? And then what kind of profit are you making from the rent?
So in these PUD areas, I've really got no limit on how many that we should do just because they're so large. And it's not like I'm going to be able to change the percentage number on amount of rentals in the area. Now, if I see everybody's doing it and rentals are getting overheated and maybe too much inventory, then maybe we pull back and maybe shift more marketing on the retail side, but we haven't had to do that yet.
So you're building retail as well. There's a retail component to what you're doing.
Very slim amount, but yes. And the main reason I do that, even though I make more money on those when we sell them, the main reason I do that is to really keep appraisals up. So we're selling to investors. Our investors are getting a 10% built-in equity position from day one. And I could go sell that retail, for example, a $380,000 house to an investor, and retail, I could go get $420,000, $430,000 for the same house.
And when you say retail, do you mean like there's a pizza shop or a hair salon, or like what kind of retail are you talking about?
Owner occupied housing. So like if you and your family are looking to buy a house and move into it, that's what a retail buyer is to us.
You could build to rent, but then sell it too if you want to. Is that what I'm hearing you say?
Yeah. So we sell to investors our build to rent, and we try to keep as many as we can. But at the same time, we do force ourselves to sprinkle in some of our retail buyers on the housing to keep our prices up because it's not like we're trying to rip off the retail buyer. It's just, they're putting less down. It's a riskier transaction from a builder standpoint. And, our prices are now competing with the other national builders that are on the same streets that we are. So we're just competing with their pricing, and that's what the prices are. But I do discount investor sales, A, because I love working with investors, and B, because I own a property management company where we manage it for them. So, as long as I take care of them, which we do, then 8 to 10 years of them being a customer, I'm going to make that profit back that I would have made on the retail side. So I continue to grow that business as well.
What are interest rates doing to your build to rent model right now? Are they affecting you in any sort of positive or negative way?
It's definitely negatively affected us as far as our keeper rate has gone down significantly. When we were at 4% for an investor loan, 30-year fixed, we could have our keep ratio up north of 50%. So, we could sell one and keep one, sell one, keep one. And because we don't have to put as much down and, it cash flows. And I'm very conservative as far as I need to see a cash flow because the last thing I want to do is real estate can always go down. But we know when it goes down, it's going to most likely come roaring back. So the last thing you want to do is put yourself in a position where if it does go down, you can, potentially lose a property. So I'm naturally very conservative every time we go into one, no matter how strong the market feels. So I'm, going 60% LTVs on all of mine and all that, that kind of stuff, which also helps the rates out and all that. But it negatively affected how many we could keep percentage wise. It also, it probably affected our sales, but I think it affected my mentality, which was the worst part, because I grew up during that depression time, and my father being a builder and all of his friends being builders, I just saw what happened to everybody. And the last thing I want to do is put my family and my team in a position where we could end up like that. So yeah, I pumped the brakes, and I probably shouldn't have, but you live and you learn. So our production was cut in half last year just for that. But we're back on track. I'm feeling a little bit more confident, and it's not like something bad couldn't happen.
It seems like you were probably concerned with interest rates that would have interest rates rising like they did. That would have a dampening effect on demand. You wisely pump the brakes and cut production in half. Have you changed that outlook for 2024? Are you ramping back up again to where you were before that?
I'm ramping back up to where we were before. And if I was so confident, I'd be like, okay, let's do double the year that we did before.
It's hard to tell in this economy where that's going to go, but are you finding that you're getting the demand and, either from buyers or from renters?
I would say the first month of the year was kind of like a shocker. And to be honest, I was focusing a ton of energy on like systems and software and not so much sales. But our first month of the year, it was like, holy shit, like where did everybody go? And I thought it was because, and I think it's starting to play out, and this is right. All of our investors, they're watching the news, and it's like rates are falling, rates are going to get cut. And they were all pumping the brakes, waiting on rates to get cut. That's what I think. And now, as you see the 10-year start to defy the narrative and sort of price back in, or take out rate cuts out of the pricing or whatever, then we've had a little flood of inflow of people in the last 2 to 3 weeks. So we went like from a 2 or 3 contracts in January to now like 13 contracts in the last 2 to 3 weeks.
It was very sensitive to the Treasury and what the Fed is saying. So tell our listeners, Brock, how they can find out more about you or get a hold of you.
I'm trying to get my online presence ramped up. I'm on Instagram the most, where we post like some videos, and we do a lot of property videos and stuff like that. But follow me on there. My little tagline is @follow.brock. And then I've got a few companies, but I'd say one is a good one to look at, because I'd love if people just saw our product. Okay, you'll see it on Instagram because we built such a sexy, modern rental property. It's not like it's when you're at dinner, you're like want to brag to your friends, look at my new rental property. So go to mynewrental.com and check that out, because I design all these things, and I try to make them cost effective from a construction side, but also sexier than any retail product out there that is going to demand high dollar, retail residential product out there that's going to demand high dollar. And it's going to do the same with our rents. It makes tenants want to stay longer, take care of the property better. And then, as property appreciates, the stuff that looks the best is probably going to appreciate better. So, I take a lot of pride in what kind of a rental product we put out, because a lot of people probably think, oh, rental property, it's going to look normal, it's going to look average, whatever. But not our stuff. So yeah, it looks super awesome. So mynewrental.com.
That'll be in the show notes. Brock, what's your favorite hack or app?
My favorite app is probably Salesforce. I built our whole system on Salesforce. So some people on my team don't even like it, but I love it. It does everything that we need it to do. And our whole system is run on top of it.
Brock, it's been fun talking with you. You have some great stories about just starting off in high school and making almost $100,000 buying wholesaling on the courthouse steps. So that's a great story, and you got a great start. And now, 14 years later, you're doing build to rent, and appreciate you sharing all that with us. Thanks so much for being on the show today.
Thanks, Brian. I really enjoyed it, man.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIGinvestor.com.